And good afternoon once again, Market Rebels, and happy Monday for our trading tune-up of this week. So for those of you new, it's great having you here. We do this every Monday, Thursday, Friday at 4 o'clock p.m. And the idea is fairly simple. They're just little trading tune-ups, little tips and tricks to help you make better decisions. And of course, that can only mean better results. Now, I'm just looking at going into the close here on the SPY. We had a nice little gap up this morning. A lot of good earnings that came out, especially in the financials. And what a turnaround. Big red candle right now. So it looks like we're down about almost 1% on the SPY. So quite a turnaround. But that's been the message and the theme here for a while is volatility. And so some of the things that we're trying to teach are to show you how to handle volatile situations. And a strategy that a lot of traders turn to is the vertical spread. Now, if you joined us last week, you know that we talked about there's really four basic vertical spreads. We have a bull and a bear, and we have debit and credit. And on Friday, I talked about that a credit spread really isn't a credit. It's a credit between those two options. The one that you're selling is more expensive. The problem is that if it's a credit spread, it's also a liability. And so by the time the broker hits you for the margin requirements, they are all debit spreads in the end. So on one hand, you can think of it as there's really no such thing as a credit spread. You're not generating income. But that raised a good question. Well, is there a reason that we might choose a credit spread over a debit or a debit over a credit? And those are good questions. And those are things to which the answer is absolutely yes. There's a lot of different reasons why we might choose one over the other. And what we're going to do this week is to talk about three of the main reasons, not the only reasons, but three that most of your professional traders and astute traders will turn to when trying to decide for debit, credit, or debit. So for today, let's take a look at our first reason, and that is going to be vertical spreads and skews. So if there is a good reason for using a credit spread over a debit or vice versa, this is one of them, where we get skews in the markets, and a skew might make us lean towards the debit or towards the credit. So what exactly do I mean by a skew, and why would we lean one way or another? Well, to start out, let's talk about, let me get this out of the way here real quick. Skews in the markets. All right, so what does this mean? Well, let's take a look at some strikes. Let's say we have an expiration date, maybe for August, and we have various strikes across the bottom. I'm going to assume that the stock is currently at 100. That's our at-the-money strike. And there's different types of layouts that you can do. I could make these all call options. I could make them all puts, or I could do a mixture. And the mixture, what's called an out-of-the-money layout, is probably the most common. And what an out-of-the-money layout means is that all of the strikes to the left of the current stock price, in this case, lower than 100, are going to be puts. They are the out-of-the-money puts. All of the strikes to the right of 100 are going to be the calls. They're going to be out-of-the-money calls. All right, so we've got a mixture. We've got calls and puts. So what we're looking at is the implied volatility for each of these strikes. So let's just say that the stock is currently trading at 20% volatility, which is just a mathematical calculation. For those of you who have had statistics, it's just basically a standard deviation. But let's say it's trading at 20% volatility. That's a fact. It's not an implied volatility. It's not an opinion. That's an absolutely thing that we can go back and calculate. And so if that's true, if the stock is trading at 20% volatility, you would certainly think that all of these strikes would also trade at 20% volatility. I don't know why the animations are not working here. Sorry about that. There we go. You would certainly think that each individual strike would trade at the same volatility as the stock. And in fact, that's what Black and Scholes assumed when they created the Black-Scholes model. Makes sense, because the volatility belongs to the underlying, not the individual options. You would kind of think, well, why would the 85 strike trade at a different volatility than the 90? They all expire in August. They're for the same underlying. So that would certainly make sense. You would expect that we would get this flat line. But in the real world, we don't. In the real world, we get stuff like this, we will find that the out-of-the-money strikes typically trade at higher implied volatilities. In other words, the curve right here, these wings are kind of shifted higher. So for the out-of-the-money calls, they will usually trade at higher implied volatilities. The out-of-the-money puts will usually trade at higher implied volatilities. There's a lot of theories on why this happens. I think really the only one that makes sense is just supply and demand. You've got a lot of people out there who want to buy out-of-the-money puts for protection, buy some cheap insurance. But if you think about it, people are going, why would I want to sell this out-of-the-money put for 10 or 15 cents and have all of this potential downside risk? But as soon as the buyers say, all right, I'll tell you what, I know the model says it's only worth 20 cents, but I'll give you 50 cents or 75, $1. They start bidding it up. And in the process, the only way to account for that is to jack up the implied volatility. Now, on the call side, we usually have speculators who want to buy these out-of-the-money calls, and not a lot of people who are real willing to sell them for next to no money. However, there is a little wrinkle that we'll usually see in the equity markets with shares, where the calls will usually be skewed down a little bit compared to the puts. So in other words, if we are looking 15 points out of the money here on the puts, far left side of the graph, that's going to be at a higher implied volatility than if we look at 15 points out to the right. And one of the reasons for that is that we have a lot of people who will sell calls. A lot of, let's say, IRA accounts, people who have got shares of stock, they don't want to be selling puts or probably even interested in buying puts, but they will sell calls against their shares. So we tend to get a lot more selling pressure on the calls. So these two pictures, this red curve and this blue one, are really what paint the picture of why we might lean towards a debit or a credit spread. So let's take a look at some, which we've talked about last week. Let's say that we have a debit spread trading for 2, which would be our calls, and what's called the corresponding put spread, which means we're going to just look straight across the board. Same expiration, same set of strikes, but they're just the puts. I can get that exact risk profile by selling the put spread. I can either buy the call spread or sell the put spread if I want it to be bullish. I'm not going to do it for this presentation, but we could do the reverse by buying the put spread or selling the call spread. Get a bearish lean. So the thing is, if the call spread is trading for 2, that's what we would pay for. That would be our maximum loss. Maximum gain would be 3. Now, the credit spread would theoretically have a maximum gain of 3, would be selling for a credit of 3, and therefore have a maximum loss of 2. So take a look. The left half and the right half is exactly the same. So what's going on here? Well, if we pay 2 on the left, we are hoping that the stock price rises the most it can be worth based on what we talked about last week and the pricing principles. In this case, it could be worth 5 points, right? We have 5 points difference in the strikes. So it's an asset. It might become worth $5 if we paid 2 for it. That means we might be able to put $3 profit in our pocket. Over on the right, if we use the credit spread, we're going to get paid $3, but remember, it's not an asset. This is a $5 liability. So what we're really doing here is hoping that the stock doesn't fall. And I've talked about this before in previous tune-ups. You can think of the one on the left as being bullish, on the right is really not bearish. So there's a distinction here why we might choose these just from that perspective. But you can see that if there are no skews, if the debit spread sells for 2, the credit spread theoretically should be selling for 3. But in the end, by the time you get both of these executed, they're going to be $2 debits, and that's because that is the maximum loss, regardless of which one you choose. So far you might say, well, what's the difference? They look the same, have same max gains and max losses. And you'd be right. There would really be no reason to choose one over another. On the other hand, what if the debit spread is trading for $1? This is going to be further out of the money, therefore the price is cheaper, and maybe make 4. Again, we can make the difference in strikes. If we pay 1 for it, we can put 4 in our pocket. Theoretically, the corresponding put spread would be selling for a credit of 4, and therefore it could lose 1. But once again, take a look at the left side and the right side. They're exactly the same. There would be no reason to say I want the debit spread or the credit spread. They're both debits at checkout. They're both going to require margin requirements, what's called a 100% margin requirement, that you cover the full maximum loss. So they're both debit spreads ultimately. But do you see how the risk rewards are exactly the same? All right, so they're both $1 debits. What if we had something like this? What if we paid $1.70 for the call spread and therefore had a 330 maximum? What would the credit spread be selling for? Theoretically, the credit spread should be selling for 330. We should be able to sell that spread, collect 330, but by the time we get hit with our $5 margin requirement, we're going to have a net margin requirement of $1.70. So once again, the left half and the right half are exactly the same. They're both $1.70 debits. So this is why theoretically there's absolutely no difference. Take your pick. Take a debit spread, a credit spread. They're both debits. Doesn't make a bit of difference until we consider SKEWS. Okay, so the question we want to ask here is, does it always work this way? If the debit spread is selling for 3, we have to pay 3. Does that mean that the credit spread will absolutely be 2? Not necessarily, and that's because of that little U-shaped graph that we saw with the SKEWS. It can vary, and in some cases can vary greatly. So let's take a look at an example. Let's say that the debit spread will cost us 2, maximum gain of 3. And we're wondering what the credit spread should be selling for, corresponding credit spread, meaning we're going to buy and sell the same strikes with the puts. We would expect it to be selling for 3 for the reasons we just talked about. But we look at our broker's platform and let's say it's for 320. And therefore the maximum loss is $1.80. Remember, this is a $5 liability spread. If you collect 320, you could lose 5, which on a net basis is $1.80. Well, now the left and right halves aren't exactly equal. And if you're indifferent between potentially breaking them apart and things that we'll look at later on in this week, you'd have to say, well, why not take the one that could potentially make more and also lose less? Now, it's a little hard to see because we've only shifted it up by 20 cents. But if you take this curve on the left, let's just say if you could take your fingers and push it up by 20 cents, that gives you the curve on the right. So if we can get 20 cents more of a gain, we therefore have to have 20 cents less as a maximum loss. We're better off on both ends. So, hey, in this case, why not take the credit spread? But notice that we're not taking the credit spread because we like the word credit. We know that by the time we get it executed, it's a debit. But we're choosing it because of a skew. All right, so in this case, we might say, you know what, let's use the credit spread. What else could we do here? Okay, so this is a little bit of a side note, little tangent, which we've talked about before with the arbitrages and looking at relative pricing. Now we also see some other interesting connections. If the spread on the right is better from a pricing standpoint, relatively speaking, and yet they're the same, what else could we do? Well, maybe we keep the one on the right that's relatively cheap, right? Synthetically, we're paying $1.80 for it. And we could sell the one that's relatively expensive. What if we did both? So what if we keep this one, but we sell this one? Now we're going to short it. We're going to be short the 100 call and long the 105. Now take a look at what's going on here. If we look at these, we have a synthetic short that's behaving like short shares of stock. If we look at these, those strikes right there, that's synthetic long. So we're short at 100, we're long at 105. What does that mean? It's a $5 loss. This is what's called a short $5 box. But notice the prices. Okay, if we had 2 and 3, and over here we had 320 and $1.80, take a look at what we're getting paid. We're getting paid $5.20 to accept a potential $5 liability. Not a bad gig. That's going to happen when you can start seeing relative pricing discrepancies. But the connections get even more fascinating. I could look at it this way. I could say that the credit from this put is financing the loss over here. There's a 20-cent gain. I can also see that this $2 credit is financing that $1.80 loss. There's a 20-cent gain. Lots of interesting connections that are going on here that should jump out immediately at you, and most people will say, never saw it. So if we did this, if we kept the spread on the right and sold the one on the left, what happens? We move to this in green. It's a short box spread for a guaranteed 20 cents. Now, don't get excited in the real world, even though these theoretically they actually do happen. by the time you get the commissions in bid-ask spreads, they're not going to be worth it. This is more of a market-making tool. But what it is designed to show you in this presentation is that by using the credit spread, you are taking the theoretically advantaged side of the box spread. And there's your edge. It's a small edge, but it's better than, if those are the only two choices you're willing to take, you might as well take the one that provides an edge. And I've talked about that before. Trading is not about what you think. It's about being able to see the quote board and finding your edges. That's what trading is about. So let's take a look. Does this really work? Let's look at service now, ticker now. We've got calls on the left, puts on the right. I'm going to use the mark, which is the halfway point between the bid and the ask. So I've got vertical spread. So here is the 430, 435 verticals. Again, a 5-point spread. If you can buy the call spread for 255, theoretically, if you buy it for 255, you should be able to make how much? 245. So theoretically, the credit spread should be selling for 245. And look at this, it's 220. It's 25 cents shy. So in a case like this, we'd actually be better off with a debit spread. Who would have thought? This happens when we tend to go with the in-the-money calls. We're going to find out we get the opposite with the out-of-the-money puts. Let's take a look up here. 295, we should be able to make a 205, right, theoretically. So therefore, we would expect the put spread to be selling for a 205 credit. And look at that, $1.70. And yet people will say, oh, I only do credit spreads. Well, you just completely shot yourself in the foot. This is not the side of the board to be on. What about if we come out here? We've got 230 for the debit spread and therefore 270 for a maximum gain. Theoretically, the credit spread should be selling for 270, and look at this, it's for 290. A little bit of an edge going here. What's going on? These are all because of SKEWS. If we ran these in a pricing model, none of this would happen. It's just a real-world quirk of options, but you have to be able to look at a quote board and see those. All right, so that is one reason for using a debit spread over a credit or a credit over a debit. So again, I always like to point out, is this a new way of seeing options for you? Is this something you're going, I've never seen this before, I've never heard of it before? If that's true, you are not understanding what trading is about. It's about seeing edges. So if you want more information like this and getting better at trading, this is what it's all about. And so we are offering, we always make this free offer for anybody who's new, a free 30-minute one-on-one coaching session with one of our many fabulous coaches, some of them with decades of experience on trading floors as market makers. So you can imagine when you get to have personalized one-on-one attention and focused on the type of strategies in trading you're doing, they can unlock doors of things that you're probably never, ever going to discover on your own. And so these are some of the things that we like to show. So I can't encourage you enough. If you really want to advance with your trading, and remember, you're the beneficiary of it, nobody else is, this is the best step you can take. Get decades of knowledge dumped onto you in a matter of minutes, things you don't have to learn the hard way. So the phone number is 815-957-9125. Please give them a call, schedule a free coaching session. Again, knowledge is a risk-free investment. There's no reason to turn it down. So I hope you take advantage of that. And if you can, please join us on Thursday, 4 p.m., Thursday and Friday, where we're going to look at the second and third reasons for using vertical spreads, whether a debit or a credit. So think about what those might be. Check with us Thursday and Friday and see if you got the right answers. And until then, we'll see you later on in the week. Thank you so much.